We're going to look at Enron because Enron is a major case that illustrates many of the points that we'll be considering when we're looking at responsible management and we're looking at governance and we're looking at those ideas. Enron, for those of you, many of you may know, was an American corporation, a very big American corporation based in Texas, based in Houston, Texas. That started as an oil trader but expanded into an awful lot of other businesses. And the big question about Enron is why? Why did things go wrong? So let's give you a little bit of background. What was Enron about is a big question. At the time, Enron went bankrupt in December 2001. It was the largest bankruptcy in US financial history. At the time of going bankrupt, the company had in principle $63.4 billion in assets. This was actually exceeded within a year by a further bankruptcy by WorldCom, and certain number of bankruptcies since then have got bigger. But at the time, this was absolutely incredible, and still remains, as seems, the turning point, the start of the latest bout of financial crises, which still seem to not to have ceased even as we talk today. Shares peaked at $90.75 each in mid-2000, but plunged to 68 cents by November the 28th, 2001. Bankruptcy was filed for on the 2nd of December 2001. Prior to the collapse, there was a massive selling of shares by senior insiders, by CFOs, CEOs, executive officers, etc. But many of the small and special investors, especially employees, were locked in and were unable to take advantage and were unable to get out from the company, and so ended up losing all their money and all their investments. Many of them actually found themselves in a situation where they not only were paid by the company, but also they had their pensions invested in company stock, and they had their what they call 401ks or mutual trusts or whatever you'd like to call them, also put into Enron stock. In fact, right up to the point of bankruptcy, when Enron senior managers and executives themselves were getting out and selling large numbers of shares, they were urging ordinary employees to invest more and more. And many of them invested through special vehicles, which meant they were not able to get out of their money out in time, and so we were trapped. Jeffrey Skilling, the senior financial officer, was jailed. Kenneth Lay, the CEO, was convicted of various crimes, but died of a heart attack before sentencing. John Clifford Baxter, known as Cliff, an executive, committed suicide. He shot himself in his car, leaving a note for his wife saying that he couldn't live with himself after what had happened and what had been done. It should be said that he had prior to this had actually been diagnosed with manic depression. In total, 17 executives were convicted of crimes in relation to the Enron scandal. I think it's important to recognise that part of the problem here was one of the things that we often talk about, which is the difficulty of valuing a company and the difficulty of understanding profits. And I think one of the bigger lessons of Enron, of course, is the nature of profits and what they are. Because part of the problem started, if you watch the videos, that there was a project in which the two traders were managing to bank large profits over various deals abroad, in which they were eventually convicted and sent to jail. And at this point, Enron became concerned because it was used to get the contracts. Not concerned, like you might expect, that it was now had allowed illegal activity to take place, but concerned that the source of its profits had actually disappeared. So actually, what they can do was that they decided to look for a new way of banking profits. And at this point, they recruited Jeffrey Skilling. And Jeffrey Skilling considered himself to be a highly intelligent innovator and disruptor. You've heard this phrase before. And he came up with the idea that the problem was that Enron was making profits for the future, and it wasn't actually being able to gain those. He felt that if the profits weren't banked when they were supposedly made, then actually, or claimed when they were supposedly made, then lesser paid men who came further in the system would claim credit for them. And so what he did was he came with something called mark-to-market accounting. Now, put simply, mark-to-market accounting is a system where you sign a contract for a future industry, in this case perhaps for the buying and selling of electricity futures, or you sign a contract saying that you're going to buy oil in a few years' time, futures of oil, and you work out what you expect the profit to be, and you bank the profit immediately. As in, you claim the profit immediately, you put the property onto your books immediately, put the profit onto your books immediately. There are clear problems with this that you can't really be sure, no one can be sure what's actually going to happen in the future. And the relationship of profit to cash is completely broken. There is no connection with the cash coming to the company when you declare your profits. In theory, it represents the value you would get if you sold that contract on the open market. So the idea is you're actually saying, it's not that you're saying you're going to get 10 million in 5 years' time, therefore claim 10 million of profit. You're going to say this contract is going to generate me 10 million pounds in the next 5 years, working out the net present value of that as a level free asset, and if we were to sell it, financialization, then this would actually allow us to rank it. The problem is it's almost impossible to value these things that we call as level free assets because there's no available market price or model. It's only when you actually try and go out there to sell them and somebody buys them, you may recognize this model from things like The Big Short, etc., that do that. Just to give a bit of brief summary, level 1 assets are assets that you can buy on any market. There's a given market price at any time. Level 2 assets don't have market values, but they're marked at fair value based on a model. This model is fed with inputs for which there are market prices, so price of similar securities, interest rates, time to maturity, etc., things like that. But level 3 assets are assets which have no discernible market value, so effectively the only way to find out what they're worth on the market would be to sell them, and therefore the people have to make a lot of assumptions and statements about trying to work out their value, which causes no end of problems, as we were to see. Interestingly enough, at a time of falling asset prices, which we have seen at the moment recently, related to the declining rate of profit, banks actually don't want to use mark to market because they're being told that actually their assets are constantly falling in value. Therefore, the revaluation of the assets at mark to market now would actually have them less than they are valued on the books. So it is a sign that these financial markets, financial theories, are not particularly well related to whatever's going on around you. Yeah, I'm just making this note here because of someone who's a scientist that Enron claimed to support the concept of the selfish gene, saying that Richard Dawkins' book, but Richard Dawkins' book does not claim that genes are actually actively selfish and that selfish behaviour is recovered. It is to do with the altitude of DNA and genes. So just a little put in for those of you who watch the videos that are surrounding this that have been produced by various people. Often you'll find that there's an attempt to blame much of the behaviour on the books like the selfish gene, but they are a massive misunderstanding of the science. One thing that should be noticed as well is that actually the people around the top end of Enron had a history of risk taking, not just in business, in life. There's certainly evidence of them going away on weekends for dirt biking trips, for various adventure outgoing plans, including one cases where an executive was quite seriously injured and was required to have stitches and was hospitalised by an accident he took place in an Enron outward bounds weekend. Those are the sort of things that they got thing of team building where actually team building might actually kill you. And so we had people who were what would be known as perhaps adrenaline junkies and were causing a great number of the problems. So what actually happened doing this? Well, Enron liked to place itself as a new player in the market. The phrase "love for sale" is related to something that Enron claimed and related about the social behaviour of many of the people around them. If you look at the behaviour of Pi, one of their executives who ended up marrying a pregnant stripper, then you can see that there was a very strange element of behaviour around this company, and they were sort of the executives were basically every time something seemed to go wrong, they found someone to blame. You would see them attacking analysts, attacking directors, attacking that, and they were not actually receiving any of the blame. So any of the models of governance behaviour that require you to state that you're going to align the interests of your directors with yourselves by large payments, if you look at the stories around Enron, you'll see that they are failing dismally, and they are. And if they're doing this, then why are they getting heavily paid? What they're being rewarded for? The model for this kind of reward for. So let's just do that. The pump and dump suggestion, where they were actually pushing shares of the market, they would try and talk them up. As we saw, as I was talking about earlier, you'll see that among Enron executives, there's a tendency to convince ordinary employees to buy large numbers of shares, and then when the price went up, they would dump their own assets onto the market in order to lock in their profits before the company got into trouble. Yeah. So what kind of options did they have, really? Well, they were at this point, their losses were getting so great. They were, as you'll sort of see in the 20-minute videos, we see them actually trying to hide their losses of things. So again, declared profits, seem to have no relationship whatsoever to cash coming into the company. And where they have losses and where they have debts, they're actually moving them into special purpose vehicles, companies that exist outside of Enron, sometimes owned and run by executives at Enron, and causing a certain number of problems for them. At this point, Merrill Lynch actually buys some assets for them, some overvalued assets, buys them, holds them for 3 months to take them out of an accountancy period, and sells them back. It was for this that 4 Merrill Lynch executives eventually went to jail, though 3 of them were cleared on appeal. So we've got a really toxic environment spreading from one company into other companies. So what was the issue? Well, the problem was that many of the people at Enron, believing themselves to be disruptors, believing themselves to be some special new idea of looking at business, were actually saying that their requirements, that their old-fashioned business, old-fashioned finance, etc., the old-fashioned thing of being an oil company that drilled oil out of the ground and sold it, was no longer exciting enough for them, was no longer profitable enough for them, and they really need to start to think about other ways of doing business, in other ways of getting it. So where's the next bigger idea? What new markets were they came to exploit? Who was pushing them, Enron? Who was pushing them? Where's this coming from? These ideas are coming from. The idea that shareholders were pushing them for greater investment and greater risk-taking here seems the wrong way around. Many of their shareholders were being convinced this was a stable company, that actually they're in it for the long term. Many of their shareholders, they were selling their shares onto the company employees, onto people into their pension funds, etc. People then locked into the shares and actually couldn't trade them on the open market. And so the idea that actually this was a shareholder value company that was operating in the interest of shareholders, as they claimed, was rubbish. The shareholders had very little influence on the company. And therefore, who is responsible for checking them? Because in the shareholder value model, we say shareholders are responsible for checking them. But here, shareholders were locked in and had no access to information, and supposed to clearly being very naive. But the other people are supposed to be checked. That they actually would sack analysts, or they get analysts sacked from businesses, from companies who did not rate them as a AAA rated bond market. So doing that, so they were able to control the analysts that were coming in there. This level of gambling had led to them being listed on the Fortune 500 as one of the world's most innovative companies and receiving awards for this. Whereas in fact they were describing a black box model of business which they themselves they didn't really understand, and which were going on. And throughout this, many journalists who was investigating Enron and who should have been asking the questions seemed to be almost hypnotised by the Enron executives, and in order to keep their access for materials, they could write stories, etc. They were supporting their thing. I was doing an MBA at the time, and Enron was a company that we were being told to study. And as a marketing genius company, as a company that was a disruptor that was pushing the way forward with great new ideas. Many of the journalist papers at the time, the articles we're looking at, were very much saying this thing about Enron, that Enron was one we had to look up to and believe in. So how did Enron make its money? They claimed they had a black box model. They told people there was a black box and they put the inputs into it and something magical happened in the box, something which they said was confidential, they couldn't tell you about it. And if they did, of course, that would spoil the magic. No, people would know about it, people would be able to copy it. And this way people fell for it. And the money came out and made them profitable. And as they were able to manipulate the numbers and doing the actuation, the numbers were always good. Until suddenly one day they were not good and the company had nothing to support itself. As we said, they were moving the debt outside. So where was the cash coming from? Well, the cash was actually their investors' cash. They were burning through their investors' cash at a massive speed, and they were claiming profits that were not generating cash, that had no profit, that had no cash element to them. So the books looked good, that they were very profitable. further people put investments in it, and the investment was used for day-to-day expenditures. So why was it doing that? People were buying shares were often people who've been convinced internal to the company, but also there were a lot of people who were reading the newspaper articles, reading the journalists and everything like this, and looking for it. Eventually, when information started coming out about the fact that, and it came out very limited. There was a journal that was published only in Texas that first came out with the first suggestions that something was wrong with Enron. And at this point, a short seller got hold of this information, and deciding that Enron actually had no cash and was basically burning through its investors' money, it started to short the shares. I will see, of course, again, we saw the famous of the big short. We saw a massive shorting of the mortgage market. Well, Enron was another one of these, another sort of this situation 7 years before. Somebody came along, but of course, in this case, again, the short sellers were the good guys. The short sellers were the ones who spotted the truth and went out to short the shares to bring them the madness to an end, bring the control down. I mean, that's the thing you have to remember. Short sellers are often paid as the bad guys for destroying good companies, but also they're the ones who expose bad companies. Yeah. So where's the money going to then? The money was clearly going to very, very well padded pay cells for internal executives. Banks were receiving lots of things. Among those banks, it might be worth looking into the list of banks that were involved with Enron, find out what happened to them, where they went to today. That's a good question.